Welcome, everyone, both here and on Zoom. It's a real pleasure for us to have Robert Koopman to give today's lecture on global trading system in a time of geopolitical disruption. Bob and I go back a very long time. Actually, when I was starting my career and he was starting his, we were doing research together. And ever since then, he's had a stellar career, first in the U.S. Department of Agriculture. Then he was the Chief Operating Officer and Director at the U.S. International Trade Commission. Last 8 years, he was the Chief Economist and Director of Statistics and Operations at the World Trade Organization. And today he is coming to us as the Hurst Senior Professor at the American University School of International Service. Bob, it's a real pleasure to have you here. I guess I should face you this way. We have students both here and on Zoom, students, some faculty, and some friends of Columbia. So it's great to have you here, and please take it from here. It's a real pleasure to have you back with us again.
Well, thanks, Jan, for the invitation. And yeah, it's been very interesting ride these past, what is it, almost 40 years now since we first met in Ithaca, where I was fortunate enough as a graduate student to work on a project that Jan, as an assistant professor, was directing. So thanks for that opportunity, Jan. So today I'm going to share some thoughts I have on the global trading system in this time of geopolitical disruption. I'm going to start with a little bit of an overview of what's currently happening in trade, and then go into what I think is likely to happen with the tensions we see between the U.S. and China, as well as the war in Ukraine, and the potential alignment of the world into different spheres of influence going back to the Cold War days. So, and through that arc, I'll be talking a bit about global commons issues, which require cooperation. And of course, the WTO, where I worked for the last 8 years, is one of those institutions that absolutely requires cooperation in order to function. So let's see if we'll go to the next slide. There we go. So the prospects for this year for trade are not particularly good. The WTO downgraded its trade forecast from 3.4% to 1%. They'll be coming up with a new forecast here in the next few days. Usually DG Ngozi wants to roll that out just before the spring meetings next week. So I expect at the end of this week, we'll probably see an updated WTO forecast, which probably might be revised slightly upward, is my guess, given the surprising strength in the global economy. And just to keep in mind that the WTO trade forecast is a volume forecast. It's not a value forecast. So price movements are, we try to remove those price movements, which we've seen a lot of given inflation for the past year. So 2022, they'll come out with the final number for 2022, and they're expecting around 3.5%. The IMF has a forecast for slowing growth in 2022 and 2023. And they also see inflation increasing in 2022 from 2021 up to 6.5% and going down in 4.1% to 4.1%. I suspect that that's likely going to be revised upward is my guess. And that will be, I think, rolled out at the end of this week, early next week. So just setting the stage that trade hasn't performed poorly at all, given all these geopolitical tensions, which is not surprising to me. I've talked a lot about the reorganization of global value chains as opposed to the retrenchment. Although I have to say that the policies that are being rolled out in the US and in some other parts of the world, which China's been doing for a while with its dual circulation policy, is definitely a sea anchor on global trade growth. However, there's still lots of movement around of those supply chains. Well, so let's talk about this. So, you know, the US, EU, and China all face different policy changes. Very recently, the US has, you know, faced the rising interest rates, but also this recent banking crisis and increased political uncertainty, including the recent indictment of a former president. That very well could be slowing the US economy, but it's not slowing as rapidly, I think, as many pundits thought it might. We'll have to see what happens with this banking crisis and the reduction in liquidity as people have withdrawn money from bank accounts and moved it into money market funds. US inflation drivers were strong fiscal and monetary stimulus that drove demand during a period of supply chain disruptions and tight labor markets. Tight labor markets continue, but we've seen withdrawal of fiscal and monetary stimulus and those rising interest rates, although economists are really trying to figure out how long the lag effect is between those rising interest rates and impact on aggregate demand. In terms of traded goods and inflation, initially it was really quite surprising. Traded goods prices during the COVID crisis went up a lot after years of being a restraint on US inflation, global inflation. But much of that had to do with the shift in the composition of demand from in-person services to people buying things that they could have delivered to their house, along with a strong fiscal and monetary stimulus, combined with the supply chain disruptions. And if you look at the research on that, much of that inflation during that time period was definitely demand driven. What's happened since then is more the supply constraints coming through, as well as services inflation remaining higher than expected. So in Europe, the inflation was driven mainly much more by supply shocks than the COVID-19 disruptions, but particularly Russia's invasion of Ukraine, disrupting energy and food supplies. What's interesting for me is very similar to what we saw in the energy crisis in the late 70s and early 80s in the US. People were surprised, I think, at the global economy's reworking of energy supply chains, as well as Europe's reduction in demand for energy as those prices went up, as well as fortunately not too cold of a winter. China faces this different set of challenges, debt challenges around property markets, the crackdown on digitally intensive sectors, which they've recently started to roll back a bit, and they've been trying to address the debt challenges. And then they've stopped the very stringent COVID-19 lockdown. And what we've seen is China's economy is seeming to recover perhaps much more strongly than many pundits thought. How sustainable that is, I think, is a very interesting question. So outside of these macro developments, security, climate, and health challenges could disrupt global trade and international cooperation. We've seen this significant ramp up in US trade policies, tensions with China over national security in the technology area. The Biden administration has amped up these export controls and are looking at other sanctions, potential sanctions on China and more export controls. What was interesting to me is that initially the US undertook these actions with very little consultation with allies, and I think surprised our political allies, particularly in Europe and the advanced Asian economies a bit. They're trying to rework that now, along with some clever interpretation of what is a trade agreement. We'll see where that goes in the next few months. At the same time, we see Europe responding both to US-led call for sanctions on advanced technology goods, but also competing with the US in terms of domestic industrial policy around battery supply chains and technology sector So it'll be very interesting to see where Europe goes with those policies, and do we enter a period of competition among friends with tight government budgets, actually, given the current debt levels, to be able to pursue these kinds of policies. A reminder there as an economist is if you're stimulating some policies in a country like the United States or even Europe, given that at any particular point in time you have fixed inputs available, those kinds of stimulus actually shift resources around in an economy. And I think it's an important question for policymakers to consider. What's the cost benefit of those kinds of policies? I haven't seen any economic assessments of these policy changes other than sort of a feeling that, well, these are high value sectors that are going to result in a stronger US economy. I think that's something I'd like to see the analysis on. And you'll see a little bit later, I'll give you a summary of analysis that we've done with some former colleagues at the WTO on global fragmentation and its impact on trade and GDP. But we have not incorporated into that kind of analysis this rising industrial policy subsidies approach. So what I see as a result of all this stuff is a lot of trade diversion, reshoring, and this diversion of resources away from other sectors in the US economy. And that this reshoring rewires global trade, likely into what I see now as three spheres of influence, sort of a Western market economy-led sphere, a China-Russia-led sphere, and then a non-aligned sphere. All of these things, I think, are pretty problematic given these global challenges, global commons challenges that we see. There's a very interesting piece, I don't think I cited in this presentation, but Gordon Hanson, who did some excellent work on the China shock impact along with Autor and Dorn, recently put out a piece on what he sees as potential impact from the green transition in the United States. And he did this for the Aspen Institute. So if you get a chance, Google up Gordon Hanson Aspen Institute Green Transition. It's a very interesting discussion that illustrates technological change can have very much the same kinds of adjustment costs and impacts on the US economy as trade shocks, probably much bigger in my view than the trade shocks. So as these US trade and commercial policies become more aggressive, we see China's doubling down on the dual circulation policy, which came well before these recent US moves, and I think probably laid the groundwork for the US to more the Biden administration to double down on these industrial policies. The idea of China's dual circulation policy is to ensure that its domestic firms capture more of the domestic Chinese market growth. You know, and as I said, we see Europe aiming to support domestic producers in the semiconductor, tech, and green transition sectors. At the same time, we have this major military conflict in Europe, disrupting both politics, energy, and food supply chains. So this all adds up to a great deal of uncertainty for global trade. And I think the next year or two likely to be ones with continued disruption in international trade as supply chains. Firms out there trying to deal with all of this policy uncertainty, trying to figure out how to balance off economic efficiency versus risk mitigation. So but I don't see this as a demise of globalization. I see it as a reorganization of globalization. We've seen very little evidence of reshoring. We've already, heard evidence of domestic supply constraints in the US with some of the Biden administration policies, though those are all anecdotal so far. But we've seen a lot of evidence of trade diversion and diversification in trade since the Trump administration put tariffs on China, augmented by the COVID-19 challenges. So global trade share of GDP has been stabilizing with variation at around 30%. We've seen much faster growth in services trade, although it's hard to measure data flows. Those also, I think, have been increasing very rapidly. So the composition of trade is definitely shifting. It's consistent with a growing share of services in GDP and a decline in manufacturing value added in most advanced economies. This decline was going on long before we had an increase in trade with China. The increased servicification of the U.S. economy as well as other advanced economies. We also see much faster services growth in China than manufacturing growth. So we see more output but less value. And automation is clearly a driver in nearly all economies. We went from ag to manufacturing to services. Increasingly now looks like in developing countries a move from agriculture to services. And I highly recommend reading Richard Baldwin on globotics if you haven't taken a look at his work. But the supply and demand balance in globalization definitely needs more attention. Supply has become more diversified, but demand still seems US and EU centric. And what I think we need there is much better macro coordination rather than trying to solve global trade imbalances with micro trade policies. I think there needs to be a much deeper discussion around macroeconomic coordination and moves on the US side around macro policy. But I don't think we're going to see that, unfortunately. I think Michael Pettis's work on repressed consumption in China is pretty important. We see significant relatively weak demand in Germany with relatively low wages. And I think, something to watch going forward is, will fast-growing converging economies encourage consumption or repress it? So watching what happens in places like India, if Africa gets back on a rapid growth pace, and if Latin America can pick up its growth pace, I think we want to watch and see what happens, particularly as countries diversify away from China. So, Trump's tariffs haven't worked to fix the US-China trade imbalances. This is some data from Chad Bown. US imports from China shows both decoupling in those products for which there are tariffs, but for those products for which there are no trade war tariffs, we've seen growth in exports. But we also see significant growth in the US from imports from other Asian countries as firms diversify. On peak globalization, this is some work Richard Baldwin has done using WTO data. On the right-hand side of this chart, you can see world goods trade by sector has had a rapid increase between 2001 and 2008, and then the pace of increase slowed between 2008 and 2020. And you can see mining and fuels playing a big role. Some of that is prices, and some of it is volume effects. On the left-hand side, you can see if we index commercial services trade versus goods trade, much faster growth in services trade and an increasing share of commercial services trade as a share of total goods and services trade. So moving on to the WTO and fragmentation, after setting the stage, that we see still rapid growth in services, goods trade mainly moving around, but it hasn't declined as many people think, although there has been variation. So it seems like international trade flows are at least being sustained during this time of significant disruption. So as I said, multilateral cooperation of trade needs to continue. It has been challenged for many years, and recent developments suggest it's going to get harder. I would argue that the world is currently on this path to fragmentation with like-minded bloc integration replacing global integration. I think this would generate significant opportunity costs. And in this paper that I did with Jean Métivier, Eddie Beckers, and Mark Bacchetta, we asked the question, what happens if the world breaks into three competing blocs, and raise trade costs between those blocs? And then we compared that with the question of what if there was further integration? What if somehow policymakers came up with some sort of miracle to take further trade liberalization, reducing trade costs and integration, and particularly cooperate. And part of our scenario here is that in fragmentation, not only do trade costs go up, but technological spillovers decline. And I'm a big believer that one of the big drivers of economic growth through global integration has been much faster technological spillovers and much faster convergence of developing countries' production possibility frontiers towards the global frontier. So what do we find in this? Well, we find that there is a lot at stake, although I guess you could say it's a relative view, with the difference between cooperation in global trade and rivalry in global trade being a total of 8.6 of global growth in 2050. Now, 8.6 is potentially 8.6% is potentially a high opportunity cost, but it is also important to realize that in this scenario, and we're using IPCC trade projection, GDP projections here, that global GDP would double during this period. So the expectation is that global GDP would double between 2021 is our base year, in 2050, and that this cooperation versus rivalry results in a difference in outcomes of 8.6% of global GDP. So we get an increase of global GDP of 3.2% in the baseline with cooperation versus a decrease of 5.4% under geopolitical rivalry. So the 8.6% is the opportunity cost. LDCs would gain the most from multilateralism. Real GDP would increase by about 5%. And political rivalry leads to 21 percentage point decrease in exports between the Western and Eastern blocs. So a big break between the Western and Eastern blocs, with an increase of trade within each of the blocs. So overall trade does go down, but not as much as 21%, this difference between the Western and Eastern blocs. So enough about the research paper. Let's move on to the backlash here a little bit. I think it's important to try to understand some of this backlash in the United States in particular. Political developments have emphasized the role of trade and cooperation around trade as driving mechanisms of a number of economic and social challenges. And recently, USTR Ambassador Tai is quoted as basically saying they're trying to fix these problems that arose from all the free trade policies as they shift to a worker-centric trade policy. And she definitely attributes much, if not the majority, of these economic and social challenges in the US to trade policy. I think that's pretty misdirected. I definitely think some are due to trade policy, but the vast majority are due to other issues. Both the trade side and the non-trade side would benefit from some improvements in our safety net, but seems to be too big a political challenge. We seem to want to talk more about political challenges around religion and guns and things like that, rather than focusing on the economics. Anyway, we see that growing income inequality, long-term reduction in manufacturing jobs, concentrated geographic income shocks. I refer back to that Gordon Hanson piece at the Aspen Institute on the green transition, and a very nice piece he does on what's happened in the coal industry. And we see that there have been adverse health and well-being outcomes. More recently, I think perhaps more valid concerns are around national security and supply chain resilience. Definitely, I do think supply chains became too concentrated, although that may have been relevant in what many firms perceived as a very stable global policy environment. But now I think with the direction that China and some other countries have been taking around national security, there's good reason to pay attention to that. Again, the question is thinking about an efficient way to go about dealing with these concerns rather than what appears to me to be pulling on what seem are simple levers that appeal to a narrative that I think is relatively inaccurate about the impacts of trade on the US. So while the literature is pretty clear that trade contributes to these challenges, it's also pretty clear that trade is not the main cause. And so the main source of a solution for these challenges lie elsewhere. However, Trump and Biden administration have pursued, perhaps with different intent, or at least maybe different rhetoric, trade policies that are characterized as solving these challenges. Interestingly, most other advanced economies, perhaps outside of the UK, has not experienced the same extent of domestic shocks while exposed to the same level of globalization and integration, and nor have they taken the same extreme policy decisions that the US has with respect to trade. I think this is an interesting chart. I did some work on this when I was at the US ITC for Congress and the administration. This was in the early 2000s, before China's very rapid rise, just after it joined the WTO, though. And what we showed then was that China's rapid growth as a share of imports into the United States came at the expense of the rest of Asia, and that overall Asia's share of growing US imports actually declined. That was probably through 2004, 2005. That actually led to some work that I eventually did on global value chains in terms of value added, because what we suspected was happening during that data was, during that evolution of that data, was that Asian countries were now shipping parts and components to China for assembly that had previously been assembled in places like Japan and Korea. And the GVC work actually demonstrated that pretty clearly. Now what we see, again, is Asia's share of US imports remained reasonably constant. So going through 2021, we can see once again that China's share had crowded out much of other Asia. However, since about 2018, you see the orange bar increasing a bit, which is other Asia. So between 2002 and 2018, we see the blue bar rising and the orange bar shrinking, and then the orange bar starts to rise again. And we can see that from about 2008, you can see a rise in the share of Asia's imports from 0.4 to 0.4, I'm sorry, from 40% to 45%. So at that point, during that rapid rise after 2008, we see that China actually rapid growth, but drove much of that 5 percentage point increase in Asia's share of US imports. But it's been stable since about 2014, and it was stable before 2008. And now China's share is declining. I think this is very useful to keep in mind that a lot of the US import challenges are not China specific. It's really, well, these are macroeconomic drivers in my view, and that the composition of US imports is driven maybe on the margin by trade policies, but the overall growth in US imports has to do with macroeconomic policies. So what's the context for multilateral cooperation? Well, we've seen slow progress at the WTO since its creation in 1995. We had multilateral agreements on trade facilitation agreement, and we had MC-12 outcomes on fishery subsidies, as well as a number of other ministerial declarations and decisions you can see at the bottom. There have been some notable plurilateral outcomes on ITA expansion, the Information Technology Agreement expansion, and recently on services domestic regulation. So I think the last ministerial, as well as some incremental progress of previous ministerials, demonstrate that there's still some room for multilateral cooperation on market access kinds of things, maybe even around subsidies. The Trade Facilitation Agreement, the WTO, recently came out with some research suggesting that its implementation has been working well and has significantly reduced trade costs in a number of countries. And I can recommend, if there's any interest, to look at some of the WTO work that we started, I think, around 2017 on measuring trade costs, all with the objective of trying to track implementation of the Trade Facilitation Agreement. So, we have these further challenges. They're well known around the appellate body, the US refusal for appointments to the appellate body. The EU-led MPIAA has made some progress here, and the number of members have increased. Recently, Japan joined, and there have even been some initial decisions under that alternative process. The vast majority of WTO members support restarting the two-tiered system. The US says they're happy to talk about it. Maybe recently they have, I'm not sure. I haven't been in Geneva, so I don't know. This Wednesday, Ambassador Tai is gonna speak at AU at the law school, and I'm gonna go and listen. In my time at the WTO, when we would interact with the US delegation, I can say that they said they wanted to talk about it. They said they needed time to get their act together to talk about it. They urged members to give them ideas. Members did present ideas, and the US continued to say, we need time and we're not ready to talk about it. My sense was the US has just put this on the back burner. There's no domestic political advantage for them taking it forward. So I don't think anytime in the near future, we're going to see the Biden administration changing their view, and they're just going to keep deflecting conversations about this. That's my sense. The national security claims, that's really pretty challenging or problematic around the appellate body, or just dispute settlement in general. I don't think that's going to be worked out. DG Ngozi has basically said these are political issues. Before that, DG Azevedo had said we shouldn't be having national security claims being brought to the dispute settlement body. We should really try to work out those in a more political environment, which, by the way, I think does reflect a bit of the US concern that the negotiation arm at the WTO hasn't been working as well as the legal arm was, and I think the US has valid complaints there. Some of the more recent plurilateral initiatives suggest that some countries' ability to hold up negotiations members may be finding a workaround on that. Ironically, the first national security claim at the WTO was invoked by Russia on trade with Ukraine, not the Ukraine. So we have this broader set of challenges. Trade tensions started materializing in 2018 with a 17% increase in bilateral tariffs. And that led to reduced bilateral trade, but with a lot of trade diversion effects. My former colleague, Eddie Beckers, did some work with Schroeder in 2020 and examined those impacts, which I think are reasonably accurate, given our ability to do economic modeling. The war in Ukraine and sanctions adopted by a number of countries against Russia disrupted long-standing economic relations. A number of studies on that, including one that we did at the WTO prior to my departure. COVID-19, supply chain disruptions, and related health and trade policy responses. I'm happy to talk about that. There's a lot of criticism around multilateral cooperation around those health and trade policy responses in COVID, and certainly against the standard of ideal. I think they fall short, but given the circumstances we were in, I think it looks to me like the WTO really did help restrain negative supply chain disruptions through export restrictions. Didn't prevent them, but restrained them and limited their duration. And then trade was absolutely critical in building up the supply chains and getting vaccines and vaccine-related supplies to developing countries. Interestingly, I was involved in some discussions, both with at the WTO with producers, the big vaccine producers, as well as developing country policymakers in the health area. And one thing that was coming through in a number of African countries was, and we then saw this play out, demand for vaccines fell like a rock. And part of that was because developing countries in Africa, some of them, basically felt that they had other health issues that were a much bigger priority, and given their morbidity profile, COVID was not as big a challenge as some of the other health challenges that they saw. So in this context, the shortages and dependencies that have become more visible in the crisis triggered talk of friendshoring, reshoring, fragmentation, and decoupling, often around broad economic security concerns and national security concerns. I contributed, well, the WTO contributed to this GVC report in 2021. This is a complex graphic, but the simple message coming through here is that US drives demand. On the left-hand side, we have images of supply chain perspective, and the size of the circles there represent the importance of countries in those supply chains between 2005 and 2016. And you can see on the left-hand side that China's role in supply has increased significantly. The US role has stayed relatively stable. Europe's role in terms of multinational manufacturing firms actually has increased a bit, but China's increased more and the US has shrunk a little bit. On the right-hand side, though, is looking at GVCs from a demand perspective between 2005 and 2016. And what you can see there is that the US remains a major source of demand for global value chains. And what this means is that the other countries are able to tap into growing US demand. And while many folks in the US consider US demand to have grown relatively weak, it's actually relative to historical experience in the US perhaps, but relative to other countries' economic growth, particularly other advanced market economies, US growth has been pretty strong. The challenge has been many of those emerging market economies who have experienced rapid economic growth have increased their role in demand, but nowhere near to the extent that they've increased their role in supply. And this is a part of that macro imbalance that I was talking about. You can see this in services also. So that was manufacturing. This is in services also. Same story applies. Rapid growth in Asia with not anywhere near as much of a change on the demand side. However, if you look at changes in global value chains, we see overall China's role is declining. Interestingly, in things like the iPhone, it's increased significantly, but in things overall, China's role is declining. But other countries remain rapidly integrating. It'll be very interesting. I think a very interesting question here is going to be, what is India's role? In the next 10 to 15 years. When I was getting ready to depart the WTO, they were very, very interested in GVCs. When I first arrived at the WTO in 2014, they were very opposed to any discussions on GVCs. But once this policy disruption started being between the US and China started to arise, I think India recognized the potential opportunity. So I think that'll be very interesting to watch. Other areas interesting to watch would be integration in Africa. If they can successfully integrate through the African Continental Free Trade Agreement, it could enhance their competitiveness, both in their domestic economies, but also globally, and might become a better destination for foreign direct investment and technology transfer and become more competitive in the global economy. And interestingly, also the Mercosur region, South America, if the Mercosur agreement hasn't resulted in much integration, if they were to rework that and have it follow more of a US or EU approach to free trade agreements and integration, you could see their competitiveness potentially start to rise. I talked about vaccines. I think I'll pass on these two slides as I've been talking for a while, but it just illustrates the importance of trade in vaccine distribution. And it's illustrative of what would be needed if there is another health crisis. Definitely, if there's another global health crisis, we are going to need global trade to respond. With this fragmentation between, say, the West and the East, it could significantly interfere with this kind of production process integration. Now, I want to talk a little bit about climate change. I think that's really, really important. There's debates about the role of trade contributing to global emissions. And I think some recent work by Koopman, Shapiro, and Taylor helps sort of really provide a strong foundation to illustrate that carbon emissions embodied in international trade recently have started to decline in intensity, while overall emissions increase. But there are some problems in bias of trade policies towards gray goods. This graph illustrates that CO2 intensity in production, those goods that have high CO2 intensity tend to have relatively low barriers, both tariffs and NTB rates, while downstream activities, which tend to be much lower in CO2 intensity, tend to have much higher tariffs and non-tariff barriers in their way. So I think there's simple things that can be done on global trade to rebalance this and get away from the policy bias towards gray goods, and would be helpful if tariffs were lower for developing countries to shift some of their economic activity to these downstream sectors and rebalance global production a bit. These barriers are not that big, but they still are addressable and easily addressable by policymakers. This does not say that trade policy fixes the problem, but you could get rid of at least one inherent bias in there. The war in Ukraine, I think, is illustrative of a number of things. Initial spikes in food and energy prices, both of which have come down pretty significantly. And I think open global markets helped rewire these marketplaces and mitigate some of those price increases. But if we sustain these kinds of fragmentation as a result of conflict between, Russia's war on Ukraine and China's support for it, we're going to end up with this increase in fragmentation, slower growth, particularly for developing countries, countries further from the global productivity frontiers, through slower and fewer technological spillovers and rising trade costs. I think I don't like to say I'm a believer. I try to be informed by the empirical evidence, and I think the empirical evidence makes a strong case for the role of trade as a mitigating factor in a number of our global challenges. We do have to have it's not going to fix it on its own. We do need to have other supporting policies, and I think that's the big challenge for global policymakers, is trying to find a way to coordinate across policy fronts where often in their own governments, they don't have good policy coordination across ministries. So in conclusion, I think we're entering a period of global trade disruption not seen in many decades. Global trade growth has slowed but not declined. Services trade growth has remained strong. Global supply chains are realigning as firms look to minimize increased political and natural uncertainty. That's risk, while balancing against search for continued efficiency gains. And these global commons challenges, I think, require increased cooperation when it appears to be declining, and very likely breaking into spheres of cooperation that could end up reducing our ability to address these challenges. So Jan, sorry, that was about 50 minutes or so, 55 minutes. I'll stop here and happy to take some questions if there's any time left. You guys are muted, so I can't hear you.
Get demuted. Okay, this was an applause that you didn't hear. We were applauding, but you saw us, so that's good. And yeah, so why don't I start with a question while others are getting ready, and then we'll take some questions, people who are on Zoom also. I think what's really fascinating is you're showing how there is this trade diversification, and that, for instance, in the Asian example, while China's share of US imports has gone down, other countries have in fact compensated for it, so the share remained roughly constant at 45%. And I'm wondering to what extent that is friendshoring. You mentioned, all sorts of shorings. Is it that what's being shifted is shifted to countries that could be described as safer in some sense, or less chaotic in the sense, and therefore friendly, be it politically or economically, etc.? And to what extent those three blocks that you were talking about, is that really something that's likely to happen? My sense is that, yes, there is some tendency, and people talk about it and write about it. But at the same time, one is struck how, for instance, China has been very careful while becoming very friendly with Putin's Russia, at the same time trying not to lose the Western markets in the sense of supplying war material or things of that nature. So there seems to be a natural tendency for countries to try to keep the markets. And I would imagine that the developing countries, or the third block, as you described it, also want to keep access to the rich markets, right? So is there really a big tendency for the three blocks to be created, or is it more shifting diversification across those blocks?
Great question, Jan. Right now, I'm a bit pessimistic. I think to answer the first part of your question, much of that trade diversion is to countries that I would put in the third category, non-aligned category. But with the recent policy declarations coming out of Washington and the Biden administration, that's going to put even more pressure on this notion of friendshoring, right? And I do think it's a real challenge for those non-aligned countries to what policy environment is optimal for them to be able to serve both China and that rapidly growing market, as well as the US and Europe. And my guess is Europe's going to be much more open to trying to avoid these blocks compared to the US political discussion. I think China is definitely trying to maintain market access in the West, but I don't think they see that as their long-term growth. I mean, that's not part of their long-term plan. So I think what we're seeing right now is hesitancy, probably for a number of good reasons. Maybe they're a little hesitant about what Russia is doing in Ukraine, but also to hedge economic bets and not cross a line that might further disrupt their trade relations with the advanced market economies. There is an opportunity for China with Russia. Russia's development level is far below China's, right? So I think that provides an opportunity for Chinese technology, Chinese capital Chinese multinationals to view a large resource-rich economy as a potential ally down the road. I don't think they view it as a big market for selling their goods, but this dual circulation approach that they had, it's a clever name, but it was really about trying to serve more of their growing domestic demand from their own production. And I think deep down that really annoyed many advanced market economy policymakers that, hey, wait a second, part of the deal was we open up our market to yours so you can grow and develop. But you open up your market to us. And between China, Made in China 2025 and dual circulation, I think a number of Western businesses and policymakers are like, wait a second, you're trying to restrict our access to what we see as this potentially wealthy market. We've done our part. Why aren't you going to do your part? Anyway. But yeah, I got to admit, I think my comparative advantage is the economics, not necessarily the politics.
Very good. Well, that's interesting that you think that there is actually an accentuation, or if you want, growth of the inward-oriented growth by China, because the Western companies were always complaining that it was difficult to do trade, have to have counterparts, have to have right to joint ventures and so on. And the hope was that it was going to diminish this restrictions and these restrictions, but you're in fact indicating that now it's again being strengthened. Yeah. All right, let's see.
Yeah. My question is that is there any tendency we see that the Western country they're pulling back their companies or their manufacturing units from China to Brazil or India or other nations that are capable of manufacturing the same thing? Okay, do you see the tendency to move away from China due to its engagement? I don't know at which level, but at certain level with the Russians.
So it was hard for me to hear the first part of the question, so thanks for passing the mic. But I think I heard it, and I don't think much of the diversification out of China are two main sources. Chinese firms themselves diversifying because of rising domestic costs, right? And also from the Chinese perspective, maybe mitigating the policy risk. And then US firms mitigating the policy risk. So there's a domestic effort moving outward, and that's been going on for some time because of those rising wages in China. That's a natural thing, I think. But then you add to the Chinese perspective, the rising policy uncertainty. And then Western firms are now hesitant about making big investments in China to serve outside markets. I do think they are still interested in investments in China to be part of that dual circulation element to meet their own domestic demand. But the countries that are likely to gain, I think, are countries like Mexico, and they might be considered in that Western sphere that I was describing. But the big gainers so far seem to be like Vietnam, Malaysia, Indonesia, and they don't want to be tightly in the Western sphere, right? They want to be serving the global marketplace. There has been discussions about movement of investment to India, and India has been encouraging that. And Modi has recently backed a big investment in infrastructure, which I think is absolutely critical. By the way, to be clear, many of the Biden policies around infrastructure investment and R&D, I'm very supportive of. I think that's a place where the U.S. made a historical mistake, just leaving everything to the free market when much of the historical model has been fundamental R&D led by the government and shared with the private sector to figure out how to make it most effective in the marketplace, and then investment in infrastructure. India, I think, has to improve its domestic policy environment and improve its infrastructure, but it's got that large market. It's fast growing. That would attract a lot of multinational know-how and investment. But we'll have to see how India navigates that.
Right. Why don't we go here?
Thank you, sir. Thank you for a good lecture. I have two related questions. Number one, when you do like investment analysis, which is a long-term thing, how do you do scenario planning? Because there's a lot of statisticity here, whether it's geopolitical or environmental crisis or another pandemic coming up. It's very hard to do that. The second question is related to India. I think everybody's forgetting the threat that's coming out of Pakistan. The Biden administration is ignoring Pakistan. They don't even want to talk to them, like president to president or president to prime minister level. And Pakistan is surrounded by Iran, China, and Afghanistan, which are like really big threats. And if you look at the Indo-Pacific economic framework and the Quad and AUKUS and all of those acronyms, it's a challenge against the Chinese, and the Chinese might be forced to work with Pakistan to increase their influence. And where do you see that threat coming from Pakistan? I think that's a very, very interesting nation that nobody's talking about and everybody's kind of ignoring. Thank you.
Well, it's a great question. One that I don't think I'm very well placed to answer. What I would like to see is discussion, more open and transparent discussion between economists who can try to interpret some of the political scenarios. So scenario development is very hard. And what the kind of work that I've put out there, I would encourage other people to take the same framework and look at some different scenarios, right? And then you could be comparing using a similar economic framework, the potential outcomes from different political scenarios. We made simplistic one. Part of my drive of that was largely that I was a Soviet specialist, right? That's what I wrote my dissertation on. And so I've got this Cold War thing way in the back of my head. I stopped working on that not long after the transition, but it does frame my view. But I think there are other more complex views. And I would love to see a more informed policy discussion where we take those policy risks and try to translate them into different kinds of economic analysis. But let me close with this. Economics rarely drives the policy outcomes, right? From my perspective, my job over the last 40 years has been to try to help give policymakers some sense of the potential economic costs of their decisions, and they make their policy decisions. What frustrated me is often, despite great capability to generate alternative scenarios and alternative perspectives, they rarely were provided. And I guess that made it easy for me, but I do think I'd like to see if there's any internal Biden analysis around the implications of the Inflation Reduction Act and CHIPS Act on the composition of the US economy. Now, academics contribute to this challenge because academics often criticize the simplistic frameworks that we use. But hey, bring other frameworks into the discussion. But most of the time, academics don't want to address the big policy questions. You advance in academia by generally either coming up with a big theory that helps change the world, or by looking into deep, clever explanations of a niche area. Sorry, that was an opinion, but yeah, I'll stop there. I hope I answered your question.
Very good.
Hello there. Thank you for speaking and coming. So my question is kind of around the changes that will happen as a result inside the WTO with other countries cooperating with the US. You mentioned that the U.S. sort of ignored appellate body meetings within the WTO, and it seemed that was because the U.S. wanted to preserve its own economic policy considerations. Do you see a scenario in which, due to the global reorganization of trade, that the U.S. would need to cooperate more with the WTO, and as a result, would that have a positive impact on tech spillover?
Yeah, so great question. I think one of the mistaken arguments in the U.S. tends to be that an appellate body decision impinges, or the WTO impinges on U.S. sovereignty. And that's just not true. The U.S. does not have to abide by any appellate body decision. It may have to then provide compensation of an equivalent amount to the lost benefits that the complainant has brought. But there's nothing that actually requires the U.S. to change its laws. And, you know, the appellate body challenge is crossed administrations. It started with the Obama administration. By the way, the first member to block an appellate body appointment was the EU. But they blocked a particular candidate, and then they eventually allowed another candidate to take the post. It's the U.S. that's blocked appointments. It participates, by the way, so don't get it wrong. The U.S. isn't like boycotting the meetings of the dispute settlement body at the WTO. They're there. They're just not allowing the appointments for the appellate body to be made. So I don't know what difference this makes, really, right? The U.S. doesn't have to abide by the decisions. May cost them a little bit in terms of economic retaliation, but you know, if they didn't have the WTO, they could be facing a heck of a lot more retaliation if countries didn't like the policies that the U.S. was imposing. And then vice versa, the U.S. has a lot of offensive interests to use the appellate body. So, you know, it's politics, I think. It's not really a significant economic thing. I do think down the line, they'd miss it if it wasn't there. And even Bob Lighthizer said if we didn't have the WTO, you know, we'd have to create it. So, and I think, you know, finding a solution to the appellate body that the U.S. can buy into that's meaningful would be good. In the meantime, the MPIA goes forward. So we'll have to see if that gains even more members going down the line.
So we're running out of time. Why don't we take a question here? And you, Emma, I see you have a question. Why don't we take those questions and let Bob answer both of them?
Okay, thank you. My question is pretty simple. It's what's your view on the current de-dollarization, and will it change the global trade environment?
Okay, and Yuma, would you like to pose your question?
Yes, thank you. So my question is about how to let some African countries or other development countries, they climb up the value chain or supply chain, because I checked out your supply chain image. A lot of countries, they are not even on that. And when I was doing a lot of research in like Uganda and African countries, they said the most important thing for them is to get the opportunity for equal trade, but this is not what is happening right now. Thank you.
Okay, thanks. Good.
Bob, before you answer, I see Merit Jano, our Dean Emeritus and your colleague at WTO for many years, has a question, so I'll read it and you can incorporate it into the answer.
Okay.
So Merit says, there's a lot of discussion in the US and elsewhere about building coalitions of the willing for further trade liberalization or plurilateral policy advancement, including through so-called joint statement initiatives. How do you assess the scope of such cooperation and potential economic effects?
Okay, thanks. So de-dollarization, I don't see it happening anytime soon. There is an increase in share of non-dollar transactions out there. it could actually be very helpful to the US in terms of reducing pressure on the trade deficit. But I just don't see that happening. And I think a very informed source to go into depth on those kinds of discussions would be to follow Michael Pettis. He's at Tsinghua School of Finance, I believe, or Brad Setzer at the Council for Foreign Relations. I think they both weigh in on that. But I don't see de-dollarization happening anytime soon. And then on Yuma's question, yeah, a big issue with Africa was we don't have data on where they are on global value chains. And we started a project while I was at the WTO to help a number of African countries start collecting that data so it could go into the GVC data. So that data that you saw in those charts didn't even include those countries. And that project, by the way, was funded by China. Which is interesting because the other day I was listening to a well-known legal researcher talk about how China was influencing the research at the WTO and invoked that as an example. And I had to weigh in and say, no, they funded the project not to advance their views on GVCs, but to help other countries understand how GVCs can help with their economic development. So we need to get the data there. And then there's a lot that they need to do on a domestic policy front to make themselves more attractive for foreign direct investment. And then Merit's question, in that paper that I mentioned, we do look at the potential economic effects of some of the plurilateral initiatives. We think that when I say we, I should be careful. I think that plurilaterals are a definite positive political development to help break the logjam on negotiations at the WTO. If you look back at the history of the GATT, it was like-minded countries taking things forward. The consensus rule at the WTO has allowed countries like India to basically handcuff and restrict all negotiations into new areas. And the world has changed very, very rapidly. But Merit, I think you probably have a much more sophisticated view. I think my short answer would be we can do economic analysis of those. They're positive, not big, but they're positive. And one thing we need to do is sort of do some game theory thinking about what it means for the potential for cooperation down the line. Right now, we're assuming that those plurilaterals would be open MFN plurilaterals, and so grant the concessions to non-member countries and be open to other non-member countries joining. But that may be something to reconsider.
Merit, would you like to add anything yourself?
Well, thank you. I mean, first, let me just say this has been a tremendous conversation. I really enjoyed it, and I find myself in agreement with so much of your assessment, and appreciate the economic work that you're doing. I guess on the it feels to me like a moment when it's very important to make progress where we can, to keep some positive momentum possible. And so this seems an area where we should hope that the system, that those won't oppose progress, and that's what I'm just hoping will be the case.
I agree. Yeah.
Very good. Well, on that positive note, why don't we thank you once again? And it's been a pleasure having you.
Thank you all. You all have a great day.
We hope to have you again next year. This is now a tradition. Thank you, Bob.
Thank you, Jan. Have a great day. Bye-bye.
Thanks. Okay.